Yeah, so welcome everyone. So today we're going to talk about the various ways of owning commercial property or investing in commercial property, to give you an idea of what the options are. If you're thinking about doing it, or you're thinking about buying more, or possibly buying into a fund or a syndicate. So we're just going to talk about the different structures that are available out there.
Yep.
So so the first and most straightforward one is direct ownership. So that's owning the property yourself, or in your trust, or your company, or in your personal name. So there's quite a few advantages or pros that we put there. So your actual name is on the property title. So what that means is you can use the property as security, and you can raise a mortgage on that property, and you have full control of it. So what you says goes, and you can also self-manage it if you want to. And the good thing is the value of the property is the value you get from the valuer. So it's not determined by the share market or anything. And you also have the option of selling the property when you want to, which is a big advantage. So it's, I guess, a liquidity thing. So and then the good thing also is that all capital gain is yours. You're not sharing that with other owners of the property or shareholders. And another big advantage is that you can, or depending on the property, you can go up to 65% loan to value ratio with your lending. So, but that would be probably good. So, do you want to cover the
cons?
Yeah.
So they're the positives. The cons with this kind of method of direct ownership is there's not much diversification. So with exposure to property funds or different bigger, you get more exposure to multiple assets. When you've got your own single property or multiple properties, you've got limited diversification based on your own summary of the amount of properties that you own, your own portfolio. Sorry. And the other one is vacancy risk. So that relates similar to the first one. You've got a larger vacancy risk because often there's you yourself or your own structures being direct ownership. You'll have less properties, which means you're more exposed to the vacancy risk. You can limit that by having those properties in really good areas, but you've still got that underlying vacancy risk with limited tenants, especially if there's only one property with one tenant that you own. If that tenant did go under or did need to vacate, that's quite a high vacancy risk. Personal guarantees are needed. So that's a massive one when you're with the lending as well. So you've got to put your own personal guarantees on any lending that you're doing, or some service contract, maintenance contracts as a landlord. They might request that there are PGs in place. So you're putting your own PGs on the line there. And liquidity, it can be slow to sell. Obviously, if it's quite a good property like industrial that we've covered, it's really good in this market in the good areas, but often it's a lot slower to sell than other classes of ownership. And the last one is landlord repairs can be costly. So given that you're a landlord or a direct owner, and there's significant repairs that may be needed, or CapEx, so capital expenditure on the building that can't be passed on to the tenants, then you've got to be able to pay that yourself, and it can add up. So those are the cons of direct ownership with directly through trust companies or in your own personal name.
So unlisted syndicates. So first of all, the difference between a syndicate and a fund. So a syndicate is generally between a small group of people and has a single property, or maybe 2 or 3 properties. So and it's basically a closed syndicate. So you're limited to those properties. It normally doesn't intend to grow any further than the 1 or 3 properties that you initially buy into. So, but with a fund, like Provincia, it's what we call open-ended. So what that means is that we are continually growing the fund. And when you invest in it, you own a share of all the properties, and you get quite good diversification over at the moment 13 properties. So yeah, so difference between a syndicate and a fund. Syndicate, you're pretty locked into 1 to 3 properties, and also normally locked in with the same shareholders over a long period. So so the good thing about syndicates, you can own a share of a bigger and a better property by going in with other people. So you could basically pooling your money to buy a much bigger, possibly better property in a better location. So generally they're externally managed through a manager. So there's no kind of hassles with the management. And so the manager deals with tenants, the manager deals with all the finances, paying the bills, rates, everything. So it's pretty much self-managed, and you as the shareholder of the syndicate basically just get your dividend and everything else looked after. So they're quite a good thing. So they're pretty easy to dissolve with syndicates because they have between probably 5 and 10 up to 20 shareholders, and generally it's easy to get shareholders to agree to if people want to sell the building and distribute the earnings and profit. So that's the good thing about a small syndicate. Valuation again is the value of the properties, so there's nothing fancy. Generally a value would value the syndicate property or properties once a year, and that is the value. It's not determined by the share market. So where there's a listed property syndicate. So the shares, you get a share of the capital gain between the other shareholders. So when it's sold, and also good thing about syndicate, generally it's low borrowings, so 30 to 40% loan to value ratio. So for that level, the bank normally doesn't require personal guarantees. So with the syndicate, you're not having to do a personal guarantee. Jack, do you want to cover the
Yeah,
cons?
the cons on this one. So once again, the liquidity, that's it's quite a big one on this one, especially to get in and out of a unlisted syndicate. So it can be often if someone wants to sell out, but the other investors within the syndicate, sometimes it can be up to, as Carl said, 10 to 20 others. It can be hard to sell because generally they'll have first right to those your parcel of shares, and then often it can go to the open market. But once again, it's quite hard to get someone from the open market to buy into that syndicate, especially, they don't know. It can be quite unknown, especially some fund managers keep a lot of the performance of individual syndicates quite private. So that can also add to the liquidity risk with unlisted syndicates. There's limited diversification, especially on the single property type syndicates. So again, like we said with direct ownership, the limited diversification is because you've got a single tenant. If that particular tenant goes under or again gets in trouble, you've got limited diversification because it might only be one tenant or a few tenants across 3 properties or a few properties. And the manager controls everything. So that's another one you've got to be careful of when looking at unlisted syndicates, is the performance of that particular manager. So what is their background? What is their experience? What controls do they have in their management contract? So that's something definitely you want to check out if you're considering looking at an unlisted syndicate structure. Usually wholesale investors only. So that's part of the restriction. Also, they've put on wholesale investors can only access certain syndicates. That again depends on what the syndicate structure is that you're investing in. There's high entry level. So again, it can be quite costly to get into it, and then often there isn't too many opportunities to do so, which in a way can be a pro, because it can be quite rare to get into certain syndicates. So that's actually a pro, but then the flip side is high entry level to get into. And they're relatively long term as well, especially if you're investing in them, because not many syndicates have a a date that they agree to sell the property. So usually it's actually a long-term play. So you've got to be prepared for that, especially with the limited liquidity in most syndicates. They can also have funding issues. So, when a property might have significant capex that hadn't been budgeted for, it might have had limited growth on the valuation. So often, you'd use the equity in it. So the equity that's increased by, and you might lend against the property to spend that additional money on the capital expenditure. But sometimes you might not have that upside in the equity, and capital expenditure may be urgent or urgent requirement on the property. And so therefore the investors often ask to actually top up or fund it. So that's something that you need to be aware of with those unlisted structures. And the last one is you can't use shares as security. So the banks won't view the shares you have. They may view the income from them, but they won't view the shares you have as direct security, unlike direct ownership, which is a big pro that we covered in direct ownership, that you can actually leverage against the individual assets.
So just on to listed property funds. So this would be, for example, like property for industry. So so some of the pros there are diversification. So I think property for industry has how many properties? About 2 billion worth of properties.
Yep.
So that's a big spread over a number of tenants and number of properties. So that's a big advantage. Obviously, being on the share market, liquidity is very easy. You can sell your shares anytime, and you can buy shares anytime. So, and you don't have to be wholesale. So basically it's a retail market. So you don't have to qualify as a wholesale investor. Generally pretty low entry price, so you can buy small packets of shares. This can be an advantage for people wanting to get started. It can be short term if you like. You can trade them. Generally, people don't with property funds. Normally, it's for the long term. You're going there to get the dividend and generally long term gain in time. So you don't have to have personal guarantees with a listed property fund or a listed property company, and also just to note, some of the listed property funds are either a trust or a company or a limited liability company. From what we're seeing, there's some advantages, tax advantages in the ones that are trusts rather than companies. So if you want to cover the cons.
Yeah, so again, the cons. So you're definitely subject to all the fluctuations in the share market. So rather than the individual valuation. So when the share market's taking a hit, on the NZX or something that's happened in the world, it can actually affect your share price, even though it might have nothing to do with the individual property itself. So you've got to be aware of that you're subject to those. The other one is the valuation is determined by the market. So like PFI, for example, they've got 2 billion, probably the NTA's around that number right now based on the valuation of their assets, but the actual valuation of the shares is actually determined by the market. So the number of people, buying and selling. So it's not directly related to the valuation of the properties, unlike unlisted funds. So that's another one to be very mindful of.
Do you want to explain NTA, Jack, and how that works?
Oh, yeah, the net tangible asset value. So when a portfolio basically values all of its properties, so the whole every property it's got has a listed valuation done, sum that together and take off any debt, and it's got the NTA, the net tangible asset value of the overall fund itself. So that's what, that's how you look at the value, but the actual valuation on the shares is actually determined by the market buying and selling.
Yeah, so at the moment, the share market's in a bit of a decline. Yep. So, for example, property for industry is their share price is way below their net tangible assets. So the value of their properties.
We believe.
It's just from what we can see
Yeah.
from the valuations and things.
Yeah, definitely. They're substantially trading well below because of the market rents. We've seen in our own properties that the market rents are really going up, and their ones are definitely under rented based on market rent. So that's something to keep in mind. So the other con is the uplift in properties values not reflected in the share price. So like a unlisted fund such as ours, we've got our valuations being completed on the 31st of March, so coming up, and any uplift in those properties values is directly related to our share price. So our share price is directly related to the net of the valuations of the entire fund. Whereas with some listed funds, any uplift might not directly pass on because it's the market sentiment that overrides that. And then the last one is you can't use shares as security. So that's another big one. Once again, you can't leverage against those shares to buy other assets.
So that moves us on to the fourth and final way to own property or commercial property. So the unlisted property fund, so that's or a trust.
Yeah.
So can either be a trust or a company. With Provincia, we're a company, and all the shareholders own shares in the company, and the company owns the property. So it's pretty close to direct ownership. And so, but one of the major pros is diversification. So you're spread across multiple properties and multiple tenants, often open-ended. So what that means is that the fund is growing and continuing to add more shareholders and properties. So with the view to increasing that diversification and number of tenants, which is really beneficial for shareholders. So as Jack said before, the valuation is based on the value of the properties, less all the liabilities. So it's really simple calculation. At the end of every year, we get the properties valued, we take off all the liabilities, so we're left with the equity, and that's divided by the number of shares on issue, and that's how we get our share price. So it's real simple calculation, not related to the share market. So of course, when you've got multiple properties and reasonably low leverage or gearing, you can get very competitive funding rates from the banks. So they're way better than approaching the bank as an individual. Of course, no personal guarantees. Normally, that's usually because of the level of borrowing. We go to a maximum of 45% loan to value ratio. Currently, we're sitting at just below 40% LVR. So banks like that, the risk is low, and they give pretty good rates. So no personal guarantees. So everyone, all the shareholders get a share of the capital gain based on the shares you hold. So it's proportional to the number of shares you hold. So Jack, you'd like to take it away?
Yeah. So the cons on this one. So again, liquidity. It can be it's quite hard to sell out. Even though it's slightly bigger than a unlisted syndicate, it can still be hard to exit a unlisted property fund. There are companies like Syndex which are helping that. So so certain companies like our one, we're listed on that exchange, so investors have the ability to actually sell their shares on that platform, which helps that liquidity. And usually there's wholesale investors only, so it's usually only accessible by wholesale investors only under the FMA. So there's certain unlisted property funds will have different requirements, whether it's wholesale or retail. Our one's wholesale, so you've got to be qualified as a wholesale investor or an eligible investor to invest in the fund. Often there's higher entry levels as well, like our minimum investment's 50k. There's some other funds that have 100k, there's some that have 200k. So it's still quite a high limit to invest, unlike listed funds, which on certain platforms you can just buy a few shares in. So it's a lot higher to enter unlisted property funds. And it's very much long term. So it's very much a long term play. You get your dividends, but your share prices slowly go up, generally speaking, over time, depending on the fund structure and the managers. And you can't use the shares as security. So once again, you can't use the shares as security to leverage into other assets, although some banks may recognize the income from them.
Yeah, so a little bit about our structure. So we're a limited liability property fund. So this diagram explains how it works. So in the middle is the fund, which is Provincia, which is just a limited liability company. So Provincia is managed by a management company, which charge fees and provides the management. So the management company has all the expertise and the staff, and looks after all the accounting, all the asset management, and so all that side's taken care of if you're investing in a fund. ASB is currently our main bank, and they provide the funding for the properties. So shareholders obviously provide their investment, which is the equity part of the equation, and in return they receive a dividend, and we pay dividends on a quarterly basis. So and also the fund has a board of directors. So on the board of directors there's one representing the management company, and there's two directors representing the shareholders. So there's a really good spread there, and that makes sure that shareholders get a say through their representatives on the board, so they get a say in how the company runs. Anything to add to that?
No, it's pretty thorough diagram.
Yeah, so we decided on a limited liability company because it was simple, easy to understand. Shareholders own shares in the company, and the company owns all the properties. So that's why we decided on that structure.
Yeah, and it gives the shareholders the closest structure you can get to direct ownership. You own the company as a shareholder, you own a part of that company, and the company own all the properties outright. So it's it's quite it's as close as you can get to direct ownership, but in a fund structure, which adds to that spread and limits that adds that diversification throughout the structure, as opposed to individual or direct ownership.
That finishes our presentation, but just like to add that we're at Provincia, we're aiming to create a diversified portfolio, and more importantly of add value properties. So that ensures that we're going to increase the share price over time, continually adding value to the properties, increasing the rent, making improvements over time. So effectively it's inflation-proof investment vehicle, because what you're doing is you're getting your dividends, and you also your shares should be increasing over time, and from what we've seen so far, better than or higher than inflation. Whereas if you put your money in the bank, you're getting a fixed return, but quite often with inflation running at 6 to 7%, that's you're losing that on a per annum basis if you just invest in cash. And
we've got those underlying market reviews built into our lease, and and some that are indexed to CPI. So as that CPI increases, those rental increases are felt by those tenants, but the rents go up. So more money for our investors, more money to pay dividends.
Okay, so just a quick brief on our strategy. So Provincia's strategy is to only invest in industrial, and the reason for that is because it's been the best performing commercial asset over the last 15 years. So we're backing a winner, and that's what we're experts in, and that's the focus of the fund. It's industrial only. We're, as I said before, something we can add value to. We're not interested in trophy buildings. We want to find really good workhorses that have upside. Areas with sound economics, so investing in mostly Auckland at the moment. We do have one property in New Plymouth, so investing in areas where there's good trade, good economics, and good industry. We also find that between 5 to 10 million is our niche value. Reason for this is once you get over the 10 million mark, you've got a pretty hefty tenant and a hefty rent. So if something ever happens to that tenant, it's a pretty big hole to fill, and you may suffer vacancy losses. So yeah, over 10 million, we find that it's hard to find a tenant to replace in that value. So we like between 5 and 10 million.
So we'll just stop sharing the presentation now. So we'll just open it up to Q&A. So if anyone's got any questions, we'll just stop sharing this now. If anyone's got any questions, feel free to unmute their mics to ask us direct, or there's a chat bar. So just feel free to type in the chat bar as well if there's any questions for us on any of the structures or any other questions. There's anything. Here's one here. Any investments without bank loan?
So currently, Provincia does have bank loan, does have a bank loan, and so we do have debt with the ASB, and so a pre-Drag's question is any investments without bank loan. I think there probably is some out there. There are some syndicates that don't have any debt.
Yep.
But even the listed property funds have a level of debt.
Yep.
I know that property for industry work around 30%, 35%. Generally, leverage is good for property. At the moment, interest rates are a little bit high. We're hoping they'll come down over the next financial year. Does that answer your question, Predrag?
Thank you.
So, any other questions?
Oh, next week we'll be back online for another webinar at 12:30, which will be talking about how to find the good deals. So how you found a good investment. So that's covering the due diligence and closing the deal. So what we've covered over the last few weeks, looking at the leases, looking at the valuations, looking at getting finance like we did last week, looking at the different structures of investment today, and then next week we're looking at how you've got a good deal and that due diligence process. So we'll see you next week. Just register as usual online. We'll send out reminders and calendar invites as well, but it'll be 12:30 next Thursday.
Yeah, and just a couple of closing points. So Provincia is open for investment now. So our current investment statement runs to the 31st of March 2023. So there's about 6 weeks to get in at the $1.51 discounted rate. We're expecting that the share price to go up. We're confident that we've got some good value over the last year. So it's probably the last chance to get in at $1.51. So if you're keen or want to find out a bit more, contact either Jack or me, and we can send you an investment statement.
Sounds good. Thanks everyone for listening.
Thanks. Good afternoon.
Yes.